Yeah. And we're live. Good afternoon. I am definitely not Debbie Faulkner. My name is Glenn Fasani, and we're here with Brandon. And if you've not seen this before, I'll give you a little background. Debbie and I and Brandon all do a lot of work with an organization that Brandon and Debbie started called the Gulf Coast Estate Planning Council. And it basically has a mission of helping people get their estate planning documents done through education and outreach. 70% of the people in the U.S. do not have legal documents. And so with many seminars and workshops over the last 6 or 7 months, a lot of other questions, a lot of things have come up associated with that. One of the funny things since this craziness with the market, well, I don't have to do estate planning because I don't have anything to plan for anymore. Or my 401k is now a 201k. So Debbie said, you know what? I just want to try to give my clients and friends and people that have been, business partners of mine to give them some information. I have a lifelong friend that I went to school with, and we've been friends forever. And he happens to be a CFA, which we know is Chartered Financial Analyst. It's kind of like the big degree in the financial business, especially when it has to do with analyzing and looking at the markets. So Debbie just said, hey, let me ask Brandon, my friend, to come on and start talking. That was one thing that we did about 3 weeks ago. And now we're on our third week because we keep getting questions and comments and people saying they really appreciate hearing this. And it's only going to be half an hour. Two things I want to say. We are now on a separate channel. The Gulf Coast Estate Planning Council didn't have its own channel because we were doing these live and in person with workshops and seminars in the Tampa Bay area, and we've gone to this format. So we were borrowing Burt Faulkner Law, their page, their YouTube channel, and we have our own now. So please subscribe to this new channel, because if you want any updates or if you want to keep getting information, it's now a different channel. So I'm sorry to confuse you with that, but again, this is coming to you from the Gulf Coast Estate Planning Council channel. The other thing, I'm going to make a shameless plug for what we've also been doing, the Family Love Letter. So this was a series that we've been doing every Tuesday, about 10:30, and it's going through the Family Love Letter, again, associated with the Gulf Coast Estate Planning Council. The Family Love Letter is a way of helping your estate planning documents come to life. What do I mean by that? Well, if in your estate planning documents, you talk about the financial stuff, the next question is, where is everything? Where are all the life insurance policies, and what are the logons to the computers? And all the things that would be the roadmap, if you would. We all have a paper trail. The older we get and the more things we accomplish and acquire, we get a bigger trail. So this is about getting all that stuff put together. And in the back, it's much more of the non-financial aspects that I think are really important. Family mission statement, things that you want your next generations to know about your family and about what's important to you. So anyway, if you are interested, these are being done on Tuesdays, Family Love Letter. If you email Carlos at BurtFaulknerLaw.com, that's Carlos at BurtFaulknerLaw.com. We will get you mailed out one of these, and we will go ahead and you can hop on the series and we can kind of walk you through how to do all that. And so I will kind of start with a list of questions and things that we had come in over the last week and try to get Brandon to kind of give us a little background. A lot of this is really not individual investment advice. It's more, hey, let's try to make some sense out of what's going on. The first question I thought was really interesting, and I've got a lot of clients and friends and family that are asking this question. Do you think we've reached the stock market bottom a few weeks ago? And are we only basically going to look at possibly going up from this point? And that's what a lot of people have been wondering, where are we with this? So what do you got, Brandon?
I still am sticking to the idea that no, we are not going to go up straight from here. That the bottom has maybe been reached, but retesting it would not be unheard of. And we're definitely going to go down again from here based on current data. So keep pushing that idea of data. If you look at the world today and go backwards in time 1 year, the stock market returns were about 5%, above where we are today. The world is not 5% different, and to put it that way, 10% of the workforce has been laid off in 3 weeks. Obviously, we took out $4.5 trillion in new debt to try and help stem the losses that this will cause on an economic scale. So I don't see how the market is down simply 5% or less, basically going back 1 year. To me, that means that, again, this rally is a relief rally, as you call it. It's people that are jumping back in off the sidelines, thinking that the worst is behind us because there are some positive developments, but we've yet to see the negative, data on earnings and company, forecasts, et cetera. So I think there's definitely right now this interim period where, the market usually tries to forecast, and historically it's done a pretty good job. I mean, it's the market returns are typically ahead of recessions, which I think is the case here. But when you don't have certainty in something like this at all, I think markets are overreacting to the possibility for vaccines, possibility for the economy reopening, and not understanding that a lot of this damage is not short term. It will be permanent. So I don't think that we should have rallied back as fast as we have. Granted, we sold off incredibly fast too. So I think, this is a speed of declines and rallies will probably be normal. But to answer the question simply, we do have, more down from here. And it'll definitely be an up and down period.
Okay, so what's interesting is and we have a whole list of questions that came in this week. And what I thought was interesting, let's take the follow-up to that. So this other question says, what do you think could cause another sell-off in the equities market? And are there any sectors that would be insulated from another downturn?
Yeah, so here's a simple stat. So in the last recession from November to January of 08-09, the market actually went positive 25%. Then in January to March of 09, it fell 27% again. So those time periods right there are very similar to what we're seeing right now. And all that changed in that window was you had the financial meltdown, kind of exacerbating the situation. The government started to step in and explain how they're going to support the markets through TARP, et cetera. The market took that positive news and ran with it. The market rallied. And then the reality started setting back in again that, there was real damage to the economy. So this is not abnormal. Typically in recessions and sell-offs, you have these ups, which, are reactions to stabilization, which the Fed did accomplish. They stabilized the bond markets. They did create a lot of liquidity in the system, but they can't stop the losses that companies will report. So I think the next leg down or next sell-off will probably come with earnings. A lot of companies will lift guidance, meaning that they will no longer issue forecasts and say, we think this is what earnings will look like. They'll suspend that. That increases uncertainty. If a company comes out and says, we don't know what we're worth anymore, that's not a good feeling for investors.
Right. And I think that you'll agree that we're seeing a lot of that. And it's fair for a company to say, I can't give guidance at this point, but how much more of a disruption do you see something like that being? Because the market hates uncertainty, correct?
Yeah, I'd say it's a lot more disruption. Starbucks announced last week that they expect Q2 earnings to be basically cut in half. McDonald's announced same-store sales are down 22% in the current quarter based on early forecasts. So there's two bellwethers right there that people thought would be fairly immune to this in a way because McDonald's drive-thrus are open. Starbucks operates internationally with some scale. So those two companies are canaries in the coal mine, arguably, for a whole sector. And their outlook is grim at best. Starbucks did announce they're not going to, they're suspending guidance the rest of the year. So again, that means that pretty much Starbucks is so uncertain of how it's going to impact them that they don't even want to try and throw numbers out there anymore because they don't know the depth of this either. So that is definitely going to impact investors' confidence, I would argue, and it should. So I think that's definitely the next leg down.
Any sectors, and the next part of that is any sectors that will be insulated from?
So we've kind of been talking about this, I think, over the last, this being the third webcast. So I still think this is a disruption, not dividend story, is kind of what I'm, kind of coined this as. So rather than focus on dividend payers, which a lot of people are still somehow obsessed with, you have to focus on disruption. So companies that are, bulletproof in the sense that they don't have a lot of debt, they don't have a balloon workforce, and they have innovation that can weather this and that they're more nimble to deal with situations. So again, I'm still going to push, cybersecurity as a sector that will operate well. Data storage and cloud computing will operate well because what we're seeing is, more people using the internet and more people using remote business services. So I think that's the area you still need to look for is how do you look for companies that are not all over the place, that aren't messy, as we would call it, and that don't have a lot of obligations. And dividends are an obligation. If a company has to pay a high dividend to attract investors, and that dividend comes under fire, then you do see companies, forced to do one of two things. One is either cut the dividend, which is usually a pretty big negative for the company, or two, it's continue to squeeze money out of their, coffers that they don't really have. So I think that's why I go back to this. I'm not saying don't look for companies that pay dividends at a zero rate, but I would focus more on a company's ability to, adapt to the situation, which requires technology and a thin workforce in a way, and thin, debt. And again, those are areas that are technology based. Usually, I would not focus on industrials or energy or anything like that.
Right, and trying to keep this kind of cohesive. There's a question here about international and the concept of, okay, I understand what's going on in the U.S. from companies and what we do in here. What's your take on specifically international look at those opportunities, and if there are opportunities, generally where do you think they would be?
So I think we touched on this before as well. International companies, those domiciled in Europe specifically, they're usually value plays, meaning they pay high dividends. They operate mostly in financials or pharmaceuticals. I don't see them ever having a growth engine. So if you look at Europe's problem for the last decade, it's been there's no Silicon Valley. There's no innovation. And a lot of their companies are behemoths. They're huge corporations that, they're bellwethers, but they're not resilient to change. So, and again, that's where we go back to this idea that if you look for a company that's disruptive, they have a unique, capacity right now, I'd argue, to try and take market share from these companies at a higher rate because there's so much change that they can't adapt and they can't rotate. So Europe is specifically, I'd say, is a pretty messy spot. You're seeing a lot of companies there that have to deal with this uniquely because they're not one country, it's an economic union. So that's going to be a further headache. Spain is not Germany and Germany is not Italy. So again, to try and have a company operate across the EU is very, very difficult right now, I'd argue. And then
the next step would be, okay, so that's Europe. What about, are there any bright spots in the globe? And there aren't any bright spots. And I think also looking at another question kind of going along that international theme, is it a specific country? Is it a specific area? What looks, and if not, then is it just US based? Because that's what a lot of people are feeling, that it just should be all just US.
I don't think US based is the appropriate answer either. I think global is a better term to use right now than international. So I don't really care where a company is domiciled. I care how a company grows and where it can grow market share. So if you look at China again as an example of an area that has growth, they do have technology companies that are adapting and absorbing the shock of this very well. So I think China might be a bright spot in the situation because they're further along the infection curve as it is. And a lot of companies that were pretty beaten up earlier in the year than they are now. So I think China may be one bright spot. South Korea might be another bright spot down the road. Their economy's held up well. They never really permanently close it. They took a different approach to dealing with this. So companies there like Samsung is an example of a Korean company that everyone knows. They're positioning pretty well to come out of this, I would argue, at least potentially, as a country, not a company. So I think those are potential bright spots. But again, it's not so much where a company is domiciled. I think you just look at change the term from international to global. Who cares if a company's based in the US if they have operations globally? To me, they're as international as anyone else is.
Right.
So that's the way I approach it.
So here's a broad question, and it's funny because I'm kind of start from the broad part of it, but because there's several questions that ask this in different ways, but also kind of are showing some concerns in areas. So here it is. What are the long-term effects the coronavirus has on the economy? That's the first question. And we'll talk about that. And then, of course, the next question, is this permanent or is this temporary? And then we'll kind of go into some other questions that are associated with it. So what the theme of a lot of questions we're having this week is this idea of just how much of a change in our world is this going to be. So let's take the big one first. Is it going to have long-term effects on the economy? And what are they?
Absolutely. I mean, it has to at this point in time. The response by the government in general is a change. If you unload $4.5 trillion in new debt to try and fight the impact of this, that leads to permanent change in terms of what the Fed's balance sheets look like, what they can accomplish going forward, how they can deal with other financial shocks down the road. So that's a permanent change right there. And every financial shock has led to permanent changes, whether it was a financial crisis and restructuring mortgages. There was entire structural changes that we implemented overnight almost in 2009 once we realized that we had to. '01, we changed accounting rules because the tech bubble led to some questionable transactions that that technology companies were basically putting on their their accounting statements to try and fudge numbers essentially. So you do have permanent changes to how companies report, how companies operate, and I think more so this time around, you're going to see permanent changes in like what sectors survive or what sectors come out of this thing, with the ability to grow and not simply survive. So that's where I'd stick to that.
So we've got about 15 minutes or so. And one thing I do want you to know is that we can take questions. We wanted to get through several of the ones that came in over the week. We're going to continue to do that and work through this list. But please, if there's something that you want to know specifically about, we're about halfway through the half-hour recap. Please, let's do that. So again, any questions, please let us type it in there. Let us know. The next thing I'm going to go to with that whole concept is definitely permanent.
A lot of change will be permanent, yes. So again, everyone's talking about a U-shaped, V-shaped, different types of recoveries. We addressed this last time. So from an economic standpoint, the recession recovery will not be a V, I would argue. But again, if you're looking at the market and different parts of it, some will be V's, some will be U's, some will be L's, etc. So that's where I think we need to like reframe this a little bit as well and realize that the economy and the stock market are not synonymous. They're parts of the whole. And the stock market as well is not the S&P 500. It's not the Dow 30. So those indexes are not representative of everything that's going on here. And that's where I think we also have to acknowledge that different companies will change, evolve, die, and those will be permanent shocks to the system that we're not necessarily accounting for. I think a lot of people are viewing this as if, it's never happened. If all of a sudden tomorrow a vaccine comes out, we can just return to life as normal and nothing changed. And I don't see it as being the point. There's a psychology effect to this where people will change habits. Things will not go back to normal because this is a permanent shock to the system. It's not temporary. It doesn't mean we won't come out of this thing quickly in a way, but it's not going to be the same as it was. I think to argue that is honestly pointless.
Right. Right. Okay. So let's go along with what clients are asking, and it's kind of interesting. They're on both sides of it, and they're saying, "Hey, if the economic data remains bleak and companies begin to report second quarter earnings that are dismal, how long can this get stretched out as far as being not that V and more like a U-shaped type of situation?" I know we have certain, we all know that certain areas are going to come back quicker than others, but I guess what the question is kind of tied with a couple of others. Are we in the first half of the football game, the second half, halfway? I know you don't know that specifically, but there are a lot of people, and some of the questions here are asking, saying, "Hey, do you think we'll be out of this for the most part by the end of the year?" So let's just go to a more specific question like that.
I don't think we're out of the woods by the end of the year. I think it would defy like logic and defy prior recessions and everything else we know. Is it going to be a 3-year recovery? Probably not. I think that's fair to say, because different from other shocks that we've had or the recessions we've had, this was a consumer side shock first, so that's unique. And it also did have preemptive responses. Typically, the government does not unload fiscal and monetary stimulus in the same way. They're usually retroactive, not proactive. And I would argue they're semi-proactive here. We have not actually technically logged a recession yet. So recessions are always measured after they happen,
right,
or before. So I think those unique approaches to this will make it a faster recovery than a traditional like L or like a long-term recovery. But I do think that some sectors suffer economic damage that is depression-like for a very long time. So again, this is where I think you have to split that argument up and say some parts of the economy return to normal quicker than others, but it's not going to be all ships not rise at the same rate.
Right. Right. And there's a really interesting question here, which is kind of looking more long term, and it's kind of saying, hey, I know one of the stats you talked about last time was how the deficit, of course, has gotten a lot larger, but how this kind of pushes that whole thing forward. And some people are indicating, what does this look like 2 or 3 years down the road? We know we get through this, and that's where the questions are coming about. Is this going to be a longer period of we've kicked the can down the road as long as we can kind of thing?
Yeah, and I think that's one thing to make note of is, talking about uncertainty here, where we're kind of taking a very like laser focused, view on the virus and the pandemic as like what the economy is reeling from. And I think what's not happening right now is no one is acknowledging the other uncertainties that are being created from this. Mm-hmm. So you're going to see other uncertainties that will emerge, one of which is, again, the deficit as being one. Another uncertainty here is going to be how quickly consumers psychology changes and they go back to, like, because that's not something you can measure, that's a matter of consumer behavior. And then third is obviously we're not really accounting for the potential that we have this thing dead wrong, in the sense that there's news coming out of South Korea that people are being reinfected or showing signs of reinfection. So what if the antibodies tests are ineffective, because you can technically could get a second round of infections even though you've already fought it off once. So there's a lot of uncertainty here that we're not addressing. We're only focusing on one thing, and that's a vaccine, right, and reopening the economy. We're not focusing on the other 5 or 6 issues that are out there that, quite frankly, no one has an answer for. So I guess to kind of tidy that up quickly, the energy markets are a huge shock to the system potentially. Their debt load is substantial. Oil's not in a profitable range. If you look at the financial burden that we're putting on future taxpayers right now, it is something that should shock anyone. We've added almost $5 trillion in new debt from trying to pre-combat this thing to an already ballooning balance sheet. And we're also doing that when we're receiving historically low tax returns or taxes. That basically means the U.S. government is, their sales are down and their debt's up. So their debt to equity ratio, as you would call it, is skyrocketing. And again, from a government standpoint, that's not a pretty picture down the road, because if there's another shock to the system in 2, 3, 4 years time, I don't really know what ammunition we have left. The Fed has kind of like really just gone off the rails here and unloaded a lot of stimulus at an unprecedented rate. And sometimes that may look good on paper, but we don't know the long-term effects of it, obviously.
Right. So here's a question, and let's take it from a couple of different sides. If I'm currently sitting on the sidelines in cash, when would be a good time to reinvest into the market?
So I think, again, going there is to reevaluate what the market means to you. And then, from that point forward, I'd say how much risk appetite you have. I'd say right now, jumping in today would maybe result in a +5, -30 kind of skew, meaning like the market could probably rally 5 more from here, but I don't see it getting much ahead of that. But you could retest the lows. So I'd say right now is not the day to just jump all in. What I'd also suggest doing is looking at, again, like an entry point approach, meaning you might want to start saying, okay, and this is a rule anybody can make on their own. You could say, if the market falls 5, I'll move 5% off sidelines. The market falls 10, I'll move another 5% off sidelines. Whatever your rule is for yourself, I would kind of enter this in stages and kind of dollar cost average back into the market. But again, I would redefine what market means. So I wouldn't just reinvest into the S&P 500 or value stocks, or broad-based mutual fund. I would pick more specific sectors and industries that we do think have better recovery patterns coming out of here.
And that was actually interesting. You went into this question. So a lot of people saying, hey, I used to just be able to do this on my own. There's a lot of questions about not getting information from their current advisors, or being not able to get to the 800 number that they've been using an online service to do it. So they're saying, they're not getting, if they don't get information from their current advisor, whether it be, robo advisor online, or whether it be there. One of the comments that was interesting, it said, hey, they're just telling me just to leave it the way it is. Don't open the statements, things will get better. Is that a good approach at this point? And so I think that's a real pertinent question. It kind of goes into the whole idea of, do I just set it and forget it and realize that things come back, or is it different this time?
I mean, I think things will come back even in an index sense, because again, you're broadly spread out. So yeah, the S&P 500 will return to normal eventually, but you do have a lot of, I'd say, sector drag there. I mean, there's entire sectors of this that are not going to rebound fast. So I'm not saying you need to try and time the market, trade the market, anything along those lines. Again, it's more of a rules-based approach, and say, what are the entry points that I will be comfortable with? Mm-hmm. What's the loss that I can stomach? And then again, don't try and pick individual stocks if that's not your thing. But I would just say a logical answer here is, do we think that energy as a sector is going to survive this or grow at a rapid rate next 10 years? Nothing says yes. Do you think financial companies are going to grow at a rapid rate next 10 years? Nothing suggests yes. So that's a pretty easy argument to I think make on the baseline here. And again, the same approach happened in 2007, 2008. If you look at 2007 and 2008, and you realize, again, we talked in this in episode 1, the real estate market was the culprit of that, sell-off, arguably. Mm-hmm. It was a big factor of it. So real estate took 9 years to recover. Anybody that held on to it, yeah, you broke even eventually. Right. But that's where I think that time horizon issue is, the second conversation piece here. It's how long does it take to return to normal? And if there's a faster route to getting back to even, or a faster route out of this, why not, reposition the portfolio to do that?
Right. And I'm really glad to see a couple of questions here, because everybody wants to talk stock market. I'm I'm glad to see some questions here about the bond market and concerns
Yeah.
about the bond market. One specifically associated with municipal. So what it kind of says, and I'll paraphrase it because it's several different questions in one, but it basically says, hey, I have a good blend. I've got a lot of money in bonds. My concerns, though, are just as much in the bond side. Talk about the unprecedented thing that the government did with bonds. Also munis specifically. So there's some questions about saying, hey, listen, you can't do much with 0% interest rates. I'm not in the stock market, or I'm backing out of the stock market, so I'm not going to sit my money in the bank. I'm looking at bonds, but yikes, it's pretty scary out there as well. So let's kind of peel apart. We got a few more minutes. Peel apart the bond market if we could.
So bond market is another area that people I think misunderstand. It's not risk free, and I think that's the first thing.
A lot of people are seeing significant downs on their bonds, and they're asking why.
Yeah. So if you look at corporate bonds as being one realm of the bond universe, investment grade, which is what you call Apple's an investment grade company, Microsoft, etc. So high quality companies issue debt. Those yields at the beginning of the year were actually not very attractive because everyone was crowding that trade. Everyone thought that okay, I'll just stretch for some income here and invest in these bonds. Those had a huge sell-off recently, so I think that's an area that you saw get beaten up that might be attractive. And the funny part is that people started crowding other trades that arguably will be the next one to potentially have issues, i.e. municipal bonds being one. So the Federal Reserve, what they did uniquely was this is the first time they started buying corporate bonds to try and create liquidity.
And let me, that's the first time ever.
Yes.
Right. So talk a little about first time ever. Once we get on this, what does it look like going down?
Yeah, so pretty much the Fed had to make a unique decision to try and stabilize all bond markets because it's kind of synonymous now. Investors own, every type. So they took congressional approval to do so, but they were able to essentially start buying corporate bonds and put on their balance sheets. Historically, they've only ever bought government issues, municipal bonds, agency-backed, things that are government entities, basically. So that's the first unique piece there. What they did, though, is it did stabilize the corporate bond market spreads. So that's why I do think there's attractive, valuations there potentially. And I'd much prefer to get a 4% yield from a corporate bond than try and get a 4% yield from a company that can't afford it, in the dividend sense down the road. Mm-hmm. But on the muni space, the other issue there is they tried stabilizing municipal bond markets, and that's another area of concern here. So in munis, you have two types, arguably big picture types. You have revenue bonds, which essentially a toll road is a revenue bond. So when municipal bonds are issued through revenue sources, they're different than what we call general obligations. Those are issued through the taxing authority of the state or municipality. That's a big issue right now for me because if you look at what we're doing as consumers, no one's driving, no one's going to ball games, no one's going to play in public parks. So the revenue on certain bonds that municipals rely on is not there. So that whole area of the municipal bond market is probably going to face a day of reckoning as well when they can't afford to pay bondholders because there's no revenue to generated to do so. Whereas at least with taxes, the state can always raise taxes and pay those types of munis. So I'd say to look at high quality munis again. I wouldn't chase high yield ones because high yield munis are typically going to be revenue backed.
Right.
So I think that's another area here where you have to kind of separate your bond portfolio into your likely winners and losers. Look at your bonds as again potentially equity like right now. They're going to have different return paths. There's no doubt about that. So I'd say bond market is not a place to sit still either. Depending on what you own, there's definitely going to be some shocks to it, and you could see pretty big blowouts in the future again if nobody wakes up to this.
Yeah. And so we've got a couple minutes left. Actually got a very short period of time left. Just tie it up. This question is really just to finish off. So in a nutshell, what does it look like for the rest of 2020?
I don't think there's a way to answer that with certainty, but I think the rest of 2020 is going to be a prolonged period of uncertainty, volatility, and I would say market, returns that are dismal, to kind of put it that way. The problem with the calendar year end is you could get lucky in December 31st, the market rally 10%, the year finishes positive. Everyone goes, look, the year turned positive. It was great. Right. On January 1, it could fall 15. I mean, the point is to try and say the outlook from a market standpoint, I do think we're gonna have wild swings. Right. I don't think we've seen the end of that. But as far as the economy goes, I don't think we're out of the woods by the end of 2020. Okay. I think there's gonna be a lot more damage to come. And I do think that a lot of companies will have to, wake up to the reality that this is not the same as it was a year ago, like we're saying.
Yeah. Well, thank you so much for, don't forget to subscribe. I was just forgot that. Thank you, Carlos. Carlos is our producer, executive director. I don't even know what we call him, but he does everything around here. So Carlos made sure to tell me to make sure to subscribe to this channel. Why? Because this is a new channel. We were borrowing Debbie Faulkner's channel, and now we have our own coming through the Estate Planning Council, Gulf Coast Estate Planning Council. So please subscribe. Thank you so much. I have my Easter shirt on because I can't bring it to church on. Yep. Happy Good Friday. I have my Easter shirt on. So everybody have a blessed Easter. I can't wear it to church. So I wore it today. So thank you so much. And we'll see you next week.